Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. Is all well in Japan? There are certain data points like 10-year Japan yield is saying that all is not well in Japan. In today's presentation, we are going to discuss what is happening in Japan bond market. In second part of the presentation, we will understand what impact it can have on other Asian currencies, and finally outlook on rupee. If we see Japan's 10-year bond yield chart, you will be able to understand that last week Japan 10-year yield touched the level which it has touched in 2008, giving us a signal that all is not well in Japan bond market. Now let me show you an interesting data point. The chart represents the yield difference between 10-year and 30-year of four countries: Japan, UK, Germany, and US. The chart is showing that the yield curve is steepest in Japan, which is indicating that Japan bond market is asking more premium as compared to other bond markets of developed country. Indirectly, it is indicating that fiscal prudence is not there in Japanese economy as compared to other developed economies. Now the question is why the Japanese yield are rising. The important point here to note is that on 20th July there is an election in Japan in upper house. Now both the parties, the current ruling party and opposition party, are giving promises that they are going to reduce the tax and increase the spending, which indeed is going to increase the fiscal deficit in Japan. National debt in Japan is close to 260% of GDP, and their interest payment is going to move from 9.9% to 12.2% of revenue, putting lot of pressure on fiscal deficit in Japan. If the fiscal deficit continues to increase, Moody's have expressed their opinion that they may downgrade Japan's credit rating, which will further put a strain on their fiscal payment as interest rate will shoot up. So in conclusion, we can say that if tax cuts happen, government will get lesser revenue. If lesser revenue government gets, it has to borrow more. If they have to borrow more, then bond yields are going to rise higher. Investor will get cautious. Moody's might downgrade. We will see an outflow from Japanese equity market, and the currency can get weaker. Now let us see USD JPY chart. USD JPY chart is suggesting that 147 is going to act as a strong support for USD JPY, and once it breaks a key resistance level of 149.50, then it is likely to move towards 151.50 in the short term, and the bigger target can be 154 and a half. Now let us discuss outlook on rupee. From last few weeks we have been suggesting to all our clients that 85.50 to 85.60 is going to act as a strong support, and there is a higher probability that the pair can move above 86 kind of level, and exactly same has happened. Now we are expecting that 85.90 to 86 is going to act as a strong support, and the pair is likely to move towards 86.50 to 86.80 levels in coming days. Now let us understand why. The first point is weakening Japanese yen. There is a positive correlation between Japanese yen and rupee. Generally, we have seen in the past that if USD JPY is getting weaker, then other Asian currencies like India will also get weaker. The percentage can vary, but the trend remains the same. The second point is DXY is likely to move higher. Last week, US inflation data came, which was suggesting that inflation is sticky in US, and probably Fed will not be in a hurry to increase the interest rate. If that happens, then DXY is likely to move higher towards 100 to 100.50 kind of levels. Adding to the above points, rising commodity price across all metal sectors suggesting that our trade deficit can be higher. And lastly, August seasonality also suggests that in the month of August, rupee generally gets weaker. So technically we can conclude that 85.90 to 86 is going to act as a strong support. At any point of time, if 86.20 is taken out, then we are likely to move towards 86 and a half and 86.80 kind of levels. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of them have taken costing between 85.75 to 86 kind of levels. To them, we will suggest that they can cover 30% of their confirmed order near 86.20. For remaining, they can wait with a stop loss of costing or 85.75, whichever is higher, and target 86.50 and 86.80. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. Will suggest them that they can keep a stop loss of 85.80 and wait for higher levels of 86.50 and 86.80. Now let us discuss strategy for importers. We have been suggesting importers from last couple of weeks that any dip has to be bought, as we are expecting the rupee will move towards 86.20, and exactly the same has happened. Now we will suggest that if any importer have missed the chance to buy, then between 86 to 86.20 they should buy for next 45 days import, as the trend remains on the weaker side. With this I will end my today's presentation. Jai Hind. फिर मिलेंगे next week. Thank you.